In this video we're going to introduce double entry bookkeeping. Now, double entry bookkeeping has been around for over 500 years now, and the purpose of it is to ensure that a business records all of its financial transactions and is able to keep track of its assets, its liabilities, capital, income and expenses. So what are these terms that we've just mentioned? Well, the first is assets, and these are resources of the business. So it might be cash that the business holds in a bank account. It might be money that's owed to them by customers, which will be received in due course. It might be machinery or land that the business owns and uses in the business, or it might be inventories or stocks that the business will sell in due course. Our second term is liabilities, and this is amounts that are owed by the business. So this might be a bank loan that has to be repaid. It might be money that the business owes to its suppliers, or perhaps money that the business owes to the government in the form of taxes. We've also got capital. Now, capital represents the money that the owner has tied up in that business. So when the business was first created, they might have invested some money into the business to enable that business to purchase equipment and assets that will then be sold. But it would also include any profits that's made by the business. After all, the profit made by the business, the excess of income over expenses, well, that's owned or belongs to the owner of the business. Our fourth term is income, and this is the amounts that are generated by the business. The most significant type of income is sales revenue, the amount of money that the business generates from selling goods or services. But there are other types of income as well, such as any interest that the business receives from savings that it might have. Our final term is expenses, and these are the costs that are incurred by the business. So this might be the costs of buying products that are then sold, or the running costs of the business, perhaps the rent of the property that the business uses. Now, the double entry bookkeeping process is as follows. When there is a financial transaction, such as a sale, there will be some associated financial documents. So, for example, a sales invoice to go with the sale. Then those invoices will be recorded in one of the books of prime entry. This is one of the accounting books that needs to be updated for all financial transactions. So we would record details of that sale in the sales day book. Then, a little bit later, we would transfer the information from the books of prime entry into another set of books called the ledgers. So, with our example, we would record the sales into our two different types of ledgers. And then finally, we would take information from those ledgers and prepare what's called a trial balance, which then enables us to prepare a set of accounts for the business. So let's go through those different stages in turn. First of all, we have financial transactions. Well, these will include things such as sales to customers or clients, purchases from suppliers, wages payments to employees, as well as bank and cash receipts and payments, as well as petty cash receipts and payments. Then we have financial documents. Well, there are numerous different types, but these would include things such as sales and purchase invoices, as well as credit notes, customer statements and supplier statements, any records of expenses paid to employees, as well as bank statements, checkbooks, paying in books, records of bank transfers and so on, as well as wages records and numerous other types of financial documents. Now, all of those financial documents will then be entered into one of the books of prime entry. And as the name implies, a book of prime entry is the first place in which we will record details of the financial transactions and the financial documents that the business has. Now, there are numerous books of prime entry. The ones that we will be looking at on this course include the following: the sales day book, the sales returns day book, the purchase day book and the purchase returns day book, the discounts allowed day book, the discounts received day book, the cash book, petty cash book and the journal. Now, we're not going to look at what each of these does in this session, but we will look at all of these throughout this course. The next set of books where we record financial transactions are known as ledgers, and we have what's called the general ledger, which is sometimes referred to as the main ledger or the nominal ledger. And in this book, every period, whether that's a week or a month for example, information is then transferred from our books of prime entry into this general ledger. And this will then help us to calculate the business's income and expenses for the period, as well as the assets, liabilities and capital at the end of that period. In addition to the general ledger, we also have what are called the sales ledger and the purchase ledger. And these are sometimes referred to as subsidiary ledgers or memorandum accounts. Again, information relating to credit sales and credit purchases are transferred from the books of prime entry into these ledgers. And these ledgers enable us to calculate how much is owed from each of the business customers. We can then chase and collect that money, and how much is owed to each of the business's suppliers, so that we can then make sure that we pay the right amounts to those suppliers. Once we've prepared our ledgers at the end of a period, we can then use those ledgers to prepare a trial balance. Now, this is simply a list of all of the balances taken from our general ledger. Again, it's then going to help us identify any errors that may have been made in the books, and secondly, it's going to help us prepare a set of accounts for a period. The accounts helps us determine how well the business has performed over a period, as well as how financially secure that business is.